Hello, Mr. and Mrs. Hess. How are you today? That's good to hear. Yeah, I'm doing well. Is your family healthy? That's good. And they all enjoyed the European vacation? Yeah, I thought they would. That'd be hard not to have fun. You're right, I am working at home today. Yeah, it was icy and snowy, so I decided to stay home, and work gives me that flexibility. You're right, and it's really cold. So if you hear dogs or kids, they might be mine, they might be my neighbors. Yeah, you know what that's like, having children and grandchildren. You're right. You did provide us with a ton of information. It's very helpful in creating this comprehensive financial plan. I think we have some items that we can help address and improve and hopefully add some value. Yeah, we can go ahead and get started. The first thing I wanted to discuss really quick is just the purpose of this plan. We want to make sure we create a framework to reach your financial goals and your objectives. And so we've broken this down into several sections. So there's a financial health section, risk management section, investment planning, retirement planning, tax planning, and estate planning sections. And then at the end of the plan, we have an action plan. That way we can address the things that need to be done first and any other important items that we want to address. Perfect. Yeah, the last time we met, we had talked about your four major goals. And throughout this plan, we'll talk about those goals, but also about other goals and objectives that will hopefully help you meet. But I wanted to first briefly mention those four goals. You wanted to reduce any estate and gift tax liability, as well as make sure your estate planning documents are in order. You wanted to look at your insurance contracts and also look at the possibility of purchasing a long-term care policy. You also wanted to reduce personal income taxes. And then with your investment portfolio, look at both getting it diversified, make sure it fits your risk tolerance, and then your investment needs and expectations, that it meets those. Yeah, and with your risk tolerance, both of you are in agreement that you're very willing to accept investment risk. So that's good that you're both aligned in that aspect. And when we analyzed your financial situation, we concluded that you definitely have the ability to accept risk. So you have both the willingness and ability to take on risk. You don't have to take on risk, though. You're in a situation where you can be very conservative or very aggressive. That's one of the benefits of having the wealth that you've created. Now, we've made a number of economic assumptions. So we put you in the highest tax bracket. Yeah, that's not a surprise. And then we also put in an inflation rate of 2.25% and an interest rate of 1%. So with inflation, it's been running higher than that here recently, but over the last 10 years, it's been lower than that number. But we can always adjust that, and we can adjust the interest rate as well. That interest rate is also the risk-free rate, and we can adjust any of these assumptions as we need to. Then for the expected market risk premium, we use 7% and the standard deviation of 11%. Does everything sound good? Any questions? All right, I'll move on then. For your summary of health, we looked at the statement of financial position, which is your balance sheet, statement of cash flow, and we also did a ratio analysis, and we did an adjusted statement of cash flow as well. You currently have 12.9 million plus in total assets. Yeah, you're really close to 13 million, and only 60,000, a little less than 60,000 in total liabilities. So your net worth is just a little bit below $12.9 million. So you're sitting really well. Your total income for this past year was over 650,000, and you had just over 367,000 in expenses. So your net disposable income for the year was $283,000. That's a really strong number. It's even better when we did the adjustments. So we did a calculation to take out John's salary since he's no longer working, but also to include 12 months of installment payments. And so when we do that, your total income increases to over 712,000, and your disposable income is over 345,000. But in our calculations that we did for the ratios, we used your normal statement of cash flow. We figured that was more conservative. Also wanted to point out that we did not include the $1 million from the gain on the down payment from your business. We did not include that $1 million. Since it was just a one-time gain, we didn't want to throw off all the metrics that we use. And so we did a number of ratios. One of the ones I wanted to point out was the current ratio. We usually want a current ratio of greater than 1, and yours was greater than 40. Yeah, that sounds like a really strong number, and it is. It's a really strong number. It's actually too strong. It's a little too conservative. You have $800,000 in CDs and another $50,000 in checking and savings accounts. So that's more than enough liquid assets to meet your liabilities. And you're getting very low returns on those assets. And inflation is going to eat away the value of those assets. So we would actually like to see less in current assets than what you have. We typically would want to see 6 months of expenses in your emergency fund. So that equates to about $184,000. And then you'll have some other expenses that are coming up. You're going to buy a new vehicle. That's about $40,000. Paying off the credit cards, about $11,000. And then you're going to owe taxes from that down payment that you received on your business. And we calculated that at about $174,000. So there's some of those current assets that we're going to either use or keep there. But we still have some excess money that we can put to work. And so we have several areas where we can look to do that. One of them is the 529 plan that you had mentioned for funding to your grandchildren. You can each give $15,000 per year per grandchild. So as a couple, you can each give $30,000 per grandchild, and that comes out to about $90,000 for the 3 grandchildren combined. Now you can also do a 5-year election, and with the 5-year election, you can take 5 years worth of that gifting and roll it into 1 year. After that, you can't give for the next 5 years. But it does allow you to put in a huge amount of money right off the bat if you would like to do that. So if you do decide to do that, that's giving $75,000 each of you. So that's $150,000 as a couple to each grandchild. So that would equal about $450,000 that you could put into 529 plans for your 3 grandchildren combined. So $150,000 for each grandchild. Now there's some positives with this. You can reduce your state income tax liability because there's a state income tax deduction involved with putting money into a 529 plan. Also, since it's under your names and not the parents' names, it doesn't count against your grandchildren's financial aid. And then there's also some flexibility too. So if 2 of the grandchildren go to college and need the money, and maybe another grandchild either goes to college and has it all paid for, or they don't go to college, either way, you can move the money around to meet the needs of your grandchildren's college expenses. So without penalty. However, if the grandchildren don't need that much money for higher education, either they got scholarships and grants and it's paid for, or they don't go to college, then if you take that money out for non-education, higher education expenses, you're assessed a 10% penalty, and then you get taxed on the gains. So yeah, you're right. That's a pretty big penalty as well. The other thing I'd like to mention with that too is putting money into the 529 plan counts against your lifetime estate tax exemption, whereas if you give it straight to the school, then you can give unlimited amounts and it doesn't count against your lifetime estate tax exemption. So giving it to the school directly has some positives as well, instead of through the 529. And then finally, also, if you were to put $450,000 into the 529 plan, there's always a chance that the markets do poorly and you just put a big lump sum in. And so the value of that could drop pretty significantly. Whereas when you dollar cost average in, maybe you don't get hit as hard if there's an immediate, financial issue or market issue, I should say. And so when we look at it, we would recommend not doing the 5-year election, but we do think it's a good idea to give the $30,000 per child 1 year gifting. So each of you give $15,000 to each grandchild. That's $30,000 per grandchild and $90,000 for the year. Another way we looked at reducing the amount of excess current assets that you have is in your vacation home. Currently, you owe about $50,000, and it's charging, the mortgage interest rate is 5%. The rates on your CDs are going to be closer to 1%, so you're earning 1 and paying out 5. We don't really think that's a really great deal. You could refinance the mortgage and get it down, but you're still going to be paying out more than what you're receiving. So we would suggest just paying that off with either excess cash flow or as the CDs mature. And then finally, the last recommendation with the excess cash that you have is in the investment portfolio. So whatever you don't need in the other areas, whether that's the car, taxes, paying off the credit card, your emergency loan, and your emergency fund, and whatever you give in the 529 plan, we can invest in your portfolio. And I'll go more into detail there. So then the one priority I would say in this section would be to talk to your children about what they think your grandchildren are going to do for college and where they're kind of leaning. The 15-year-old, you might have a better idea. The 11 and 10-year-old will probably be a little bit harder. But maybe your children already have some college plans, and maybe already have 529 plans that are set up and will meet most of their needs. So we'll want to talk to them first, and then come to a firm conclusion on the 529 plan. And then, like I said, pay off the vacation home with the excess cash flow and the CDs mature, and then invest the rest of the proceeds that you aren't going to use elsewhere. Is there any questions there? All right, well, I'll move on to risk management then. So we have a number of scenarios and analysis that are attached to this plan. We looked at your home insurance, auto insurance, a number of other insurances as well, which we'll talk about, and long-term care insurance as well. Your primary residence, you currently have homeowners insurance of $400,000, but your value of your structures are $775,000. So typically we'd like to keep about 80%, or we'd like coverage of at least 80% of your structures. So that comes out to $620,000. So your coverage is low by about $220,000 lower than we'd like to see. So yeah, you're right. We want you to raise that. We want you to increase that amount from $400,000 to $620,000. But one of the ways you can reduce the cost of this is by increasing your deductible. Right now it's at $500, and you can increase that to $1,000 or $1,500. Increasing the deductible is not going to harm you if something does happen. You have plenty of funds to cover the deductible. But what we really don't want to see is for a big event to occur and you to have a large difference in the flow. So that $220,000 is a much bigger deal than the raising of the deductible. So we don't want you to see losing $220,000 if something bad were to happen. We'd also checked out your homeowners on your vacation home. That policy is good. We recommend at least $440,000. You're at $460,000. But you do live near the Connecticut River, or that home is near the Connecticut River. So there is a pretty good chance of flooding. And so we didn't see any flood insurance coverage. So you can add that either as an endorsement or possibly a separate flood insurance policy. And then another insurance that we highly recommend, especially for a couple like you, is umbrella insurance. Are you familiar with umbrella? No? Okay. A lot of people are not familiar with it. Umbrella insurance provides extra insurance over what your homeowners and auto insurance cover. So let's say you're in a really bad accident. Say there's a 10-car pileup, for example. A couple of the people get seriously injured, and they sue you. So that there might be health bills that go beyond what your auto insurance covers. plus the lawsuit. And insurance coverage will help protect you against that. Or you can imagine someone walking up at your doorstep and maybe they slip on the ice like a day like we have today, and they hit their head really hard and have to go to the hospital. And again, maybe there's a lawsuit. And umbrella coverage will help you with that. And especially in your situation where you have a lot of assets, you're more likely to have someone come after you with a lawsuit. So we normally would recommend $1 to $2 million in umbrella coverage, but you have significant wealth. And so you're a bigger target for lawsuits, and we want to protect those assets. So I'd be looking at closer to $10 million in umbrella coverage for you. With your auto policy, most of it's pretty good. Your property damage, though, is only at $15,000, and we think that could be pretty easily surpassed. And also with the umbrella coverage, that usually requires property coverage of $50,000 to $100,000. Some are $50,000. Some people will require, or some companies will require $100,000. So we'd like you to bump up that coverage up to $100,000. And again, you can offset some of that cost by raising the deductible for comprehensive and collision to $1,000. We also didn't see any insurance on the stamp or boat. The stamp in particular, that's got a lot of value, and we would hate for that to get damaged and you to not get anything for that. So again, you can add that as an endorsement possibly, or get specific insurance for the stamp and boat. Now, we also checked out your health insurance coverage too, correct? Yeah, you have Medicare. Right now, you're signed up for Medicare Parts B and D, but you're missing Part A, which is the hospital coverage and skilled nursing coverage. Part A does not cover long-term care, but you still are missing it, and it's something that we think you should add so that it encompasses your whole health. So we want you to be covered if you end up going to the hospital for any reason. So we'd suggest adding that, and you can do that through either Part C. Medicare Part C will add A, B, and usually D together. We'll want to make sure D is included. Or we can go get Medicare Part A, and you can have Medicare Part A, B, D, and then possibly even a Medigap policy. But all these are things that we'll want to look into further and also discuss with your insurance agent to make sure we're not getting too much insurance, because you do have enough wealth to cover a lot of things, but we want to have enough health insurance coverage, especially for big things that can happen, to make sure that you're covered there. And then finally, we looked at the long-term care insurance. We priced a comprehensive policy that covers each of you, and you share in the other spouse's policy benefits. It's for 3 years and up to $360,000. The premiums aren't bad, and both of them are tax deductible. The long-term care insurance is reasonable, and you can definitely afford it, so neither of those are problems. However, you do have considerable wealth, and so the question becomes, do you want to get long-term care insurance, or is your wealth enough? You know, do you have enough wealth to self-insure and not have to pay those deductibles? And we would say you definitely have enough wealth to self-insure on the long-term care insurance piece. But that's one we can go back and forth with. Like I said, it's reasonable. It's not a bad price. You get good coverage, but you have enough assets to cover that insurance without running into any problems, we believe. So we would recommend not getting the long-term care insurance, but we can understand why you would want it as well. And so implementing that, setting up an appointment with your insurance agent. And again, that's something we would want to do as soon as possible to make sure we get the coverages set up the way they need to be. Any questions there? Perfect. I'll move on to the investment planning then. So we have a investment policy statement prepared. We can always adjust this, and we've attached it to the plan. You currently have over $3.8 million in non-qualified accounts and almost $1.6 million in qualified accounts. So qualified just means It's in a tax-deferred or non-taxable account. There's some benefits to being in a qualified asset, qualified account. The assets that you have are all in deferred taxes. The non-qualified accounts are taxed normally. You get long-term capital gains. Dividends are taxed at favorable rates, but a lot of the interest that you get will be included with your normal income. So we'll have some recommendations on your non-qualified assets to try to bring the taxes down. So you also have your individual stock portfolio. You only have 4 stocks in there, so it's not well diversified. It's also been underperforming on a risk-adjusted basis. And then in your mutual fund portfolio, there's a fairly large allocation to international. It's not bad. And within your whole portfolio, it's not bad at all. But we like to look at things across both the portfolio aggregate level and the account level. And we want diversification at both the aggregate level and the account level. That being said, we do move the assets around based on what benefits we can get in each account. So with your qualified money, we'll invest that different than your non-qualified money, even though we want both of them to be diversified. Okay, and then with John's 401k account, you own the S&P 500, which is good fun. It's highly diversified within the U.S. large and mid-cap stock space, but you lack bonds. You don't have international stocks or small cap stocks. And then Mary, in your 403b, you own the 2025 fund, and it's very well diversified. However, it doesn't really match with your risk tolerance and your overall asset allocation. So we think we should make some changes there too. So our first recommendation would be to change the titling on the mutual fund portfolio to be joint tenants with rights of survivorship. We'll get to that in the estate planning as well. That'll help out with that. But then you can combine it with the stock portfolio, and also any excess cash that we have or excess income that comes in, we can put into that account as well. In regard to that individual stock portfolio, you only have the 4 stocks, so it's not diversified, and you also have 20,000 in losses combined. Now, all those losses are in that stock A, which has 218,000 in losses. The other stocks have accumulated gains of 198,000. So we would recommend selling stock A and taking that loss, and then when we can use that tax loss to offset the gains from trimming or completely selling out of B, C, and D, because we really want to diversify that account more. And even though it's being combined with the mutual fund portfolio, and that'll be just one account, we still want to diversify it more than just having those 4 stocks in it. And you'll also have at least at minimum 20,000 in tax losses that you can use. You can use 3,000 of it this year against ordinary income, and the remaining 17,000 that we can use in the future, either against investment gains or against ordinary income. So then in that account, we'd also look to diversify more into municipal bonds. Sorry, I was going to say mutual funds. Not the mutual funds per se. We want to use our municipal bonds, which are tax-free municipal bonds, in that account. And then we'll use tax-efficient ETFs and tax-efficient mutual funds. And then we'll also lean towards more individual growth stocks, which pay little or no dividend income, and that we plan to hold for the long term. And that's important that we hold them for the long term, because if you're churning, you're going to create a lot of taxes. So these are stocks that we don't want paying a huge amount of income, so they don't get taxed. And we want them to grow and to not have to sell them. That way they can grow kind of tax deferred in essence, because we're not going to take the taxes on them until we sell them, which is hopefully in a long time. But we also realize that you still may need to generate some income from this portfolio. So we'll keep that in mind as we invest these funds. And then John's 401k, With the S&P 500 being in there, that being the only asset. Also, John, with you turning 72 within a year, you'll be required to make an RMD, take an RMD. And so we would suggest you diversify more, add the international stocks, add the small cap, and add the taxable bonds in this account. And so the reason why we're doing that is, one, we've already had the growth stocks in the in your non-qualified money, and so we want to lean this account to more dividend-paying value stocks. It shields the dividend from being taxed, and so we think that'll be helpful. And then having the diversification with the international and the small cap stocks will really round out the stock portion. The taxable bonds allow you to generate higher returns than what a municipal would be. You don't need municipals in your retirement accounts. There's no benefit to doing that. So we have the taxable bonds in your 401k. And then the other thing that's helpful with the bonds being in there is if we run into a market that's not doing well and you're required to make a distribution, we don't want to have to sell stocks at a bad time. We would rather sell the bonds when the markets aren't doing well. And then when the markets are doing well, that's when we will sell the stocks to meet the RMD. And that goes for you too, Mary, with your account. We would set it up very similarly as John's. And so with that one, like I said, the 2025 fund just really doesn't fit in with your risk tolerance and asset allocation. So we'd invested very similarly as John's 401k account. And then one of the other things I would bring up too, as we talk about this, is taking the 401k and the 403b and rolling them over into IRAs, into the traditional IRAs. And I'll talk about that a little bit further here under retirement planning. But I think it would be advantageous to turn both of those into traditional IRAs. So for implementation, we need to set up, on our end, we'll set up the qualified accounts, and we need to set up an investment management account for your non-qualified investments. And then John and Mary, you'll need to talk to your 401k provider and your 403b provider. But we can also do that with you together at our next meeting. So we can be with you and give them a call as long as we have their contact information. That way we can get the ball rolling on getting those sent over to our firm so we can manage those investments. And with your non-qualified money, that's a little bit simpler, actually. We don't even need to contact who you have now. We'll be able to do that without you contacting them. We can get that money transferred over pretty easily. Any questions? Yeah, we'll get the paperwork taken care of on our end with most of those things. The 401k and the 403b are just a little bit different, and so we'll need you with us on those discussions with the providers. Mm-hmm. All right, onto retirement planning. We did some calculations with your expected return on the portfolio, and I'll let you look at those. So they are expected to continue to grow, which is good. You had asked about one way to grow ways to grow the assets tax-free. We could convert the 401k and the 403b to Roth IRAs, but you're going to take a big tax hit. So over $390,000 for John's IRA and over $201,000 for Mary's 403b if you do that. They would grow tax-free after that, though. So you'd pay the initial taxes, and then they'd go tax-free. We would not recommend doing this. You're in a high tax bracket right now. There might be a time in the future where you're in a lower tax bracket. And we'd work with your accountant on when a good time, if there is ever a good time to convert those into Roth IRAs would be. So we can look at that maybe in the future, but I would not do it right now just because of the hit you're going to get with taxes. And you also want to make sure that with your RMDs that you're waiting as long as possible. That's not going to be much of a chance for you, John, but we can still wait on Mary to wait as long as possible before we take the RMD. So don't take them out early. Now on to income tax planning. We did a number of things here too, looking at the capital gain on the down payment, taxes on your first installment payment. We looked at the inverted Jenny stamp if you sold it in 10 years, and we did an itemized deduction sheet for 2021, which I'll let you look at. You are a significant payer of taxes, about $175,000 this year between federal and state. And then in this next year, we're looking at the taxes on the business sale. So that down payment will generate about $174,000 in taxes. Also wanted to mention this past year you gave $13,500 to charity, which is really nice. And we have some ways actually to give in an even better way. With that inverted Jenny stamp, we assumed that you had sold that in 10 years at $1.55 million. And assuming a 15% commission and 28% tax rate, you're looking at almost $229,000 taxes 10 years from now. So that's what we're looking at for that, with different tax rate changes and different, maybe the tax is worth, or the stamps, or maybe the stamp's worth more, maybe it's worth less. But that's kind of a rough estimate of what you'd be looking at for taxes in 10 years. Yeah, and as for recommendations to reduce your income tax, we've already discussed on the investment side, using municipal securities, using the more tax efficient ETFs and mutual funds, the higher allocation to growth stocks, and we'll do tax loss harvesting as well. And then also the thing I really wanted to talk about on this section would be to look at a qualified charitable distribution, or a QCD. You cannot take a QCD from a 401k or a 403b. So that's another reason to convert those over to traditional IRAs. But with a QCD, what you do is you can directly give from your IRA to the charity, and it does not count against your taxable income. It does not show up as in your gross income. And you can do $100,000 worth of QCD per year. So with your $13,500, we could have given that directly to charity, and that way it wouldn't even show up as income, which helps out with your Medicare premiums and other things as well. Then moving on to estate planning. I should ask first though, any questions on that? Really interested in that QCD? Yeah, a lot of people are really interested in that QCD, and we'll be able to do that this coming up year as you turn 72. For the estate planning, we looked at your gross estate and probate, marital deductions, tax base, your new cost basis as well, and any federal state estate tax liabilities. So we ran the gamut on your estate to see how it looked. The good news is that neither of you is subject to estate taxes at the moment if you were to pass away, which is good. There are, however, large administrative expenses and assets that will go into probate. So we can reduce that through titling and beneficiary changes. There could also be tax law changes that might affect your estate, the taxability of it, so that might change going forward, where they'll reduce the amount that you can use to reduce that estate. And so right now we're close to $23.4 million for a couple, but that could change. And then also with the estate, you could grow past that amount. So right now we're looking at $12 million, but if you continue to grow the assets and returns continue to be strong, you can get past that estate deduction. So you could end up being taxed. And so we'll want to make sure that we pay attention to the estate tax exemption, any changes with that, and also as your assets grow, to make sure with the estate tax exemption that we're planning for that. Also, you have the will, which is good, but you're missing the power of attorney, or POA, and a healthcare proxy. So the recommendations would be to change the beneficiaries on your 401k and 403b from your estate to individuals, so either to your spouse or to your children. And this will keep them away from probate and also reduce the expenses, the administrative expenses on that. We also want you to change the title on your vacation home, automobiles. I'm not familiar with boats, I'm sad to say, but if there's some titling on your boat that we can change to joint tenants of rights of survivorship. That way we can avoid the costs in probate as well. And those assets, which then, if we do it with joint tenants rights of survivorship, would automatically transfer to your surviving spouse. That's also part of the reason why I suggested changing that mutual fund portfolio to joint tenants with rights of survivorship as well. So there we're going to want to speak to your estate attorney. You're going to want to speak to your estate attorney, set up a time to go over everything, to get the power of attorney set up, to get the healthcare proxy set up, and also see if trusts are desirable to shield your estate. So right now you're fine, but in the future we might need to set up a trust to protect from the estate taxes. Any questions? Yeah, I know that sounds like a lot to do. So the action plan, we only have 5 things though. So some of those things we can defer till later. First thing you need to do is set up that appointment with your estate attorney to get that POA and healthcare proxy and to look at trusts. And I would do that as soon as possible. And then also with your insurance agent too. I would set that appointment up as soon as possible. Now, disclosure and transparency, I want to make sure that you know that the insurance agent will pay our firm $1,333 if you become our client. So just so you know that there is a conflict of interest there, and he will pay us if you become our client. So I want you to be aware of that. We'll want you to change the titling and the beneficiaries on the assets we discussed. That way that it'll help out with your estate and estate planning. And then you can either contact the 401k provider and 403b provider, or we can contact them together to get those assets transferred over to us into a traditional IRA. And then we'll also get the non-qualified money paperwork set up so that everything's ready to go and we can invest the portfolio accordingly. Get it set up the way that will benefit you for the long term and reduce taxes and hopefully have some good gains. So when's a good time to set up the follow-up meeting? 2 or 3 weeks from today work? Yeah, that day works really well for me. Let me mark that down on the calendar here. All right. Now, you got to tell me about that European vacation, how that went.